So we'll start the session. Hello, everyone. Good evening. So firstly, I would like to thank each and everyone for taking the time out from your busy schedule and joining in today. So it's a special day again. We've invited two guest speakers from IIFL AMC, India Infoline. And so today what we thought is we'll kind of invite these gentlemen and try and read their mind in terms of where the markets are headed. A, please also to understand what is the kind of investment philosophy which is followed at their organization. So I can see that some of you might be joining it for the first time. So let me have the a privilege of introducing both the gentlemen. So the call is accompanied by Mr. Ananya Kumar. He is the head of sales at IIFL AMC, recently taken over as head of sales, and before that he used to work for Invesco Mutual Fund as head of sales for retail business. And he is MBA in finance and brings about almost 2 decades of experience on the table, almost 22 years to be very precise. And we also have Mr. Mayur. Mayur is the fund manager and he brings about 15 years of experience on the table. And before joining IIFL, he used to be a part of DSP Mutual Fund. He was also awarded as the best analyst for picking up stocks in the energy space earlier. So welcome to both of you gentlemen. Welcome on the show of Ask the Expert.
Thanks.
Thanks, Vikas.
Thanks, Vikas.
All right, thank you. So, what we do is essentially, AIF and PMS Experts India is one of the largest digital platform in India today. So we've got about 200 families whose money is something that we manage. And so our attempt is basically what we felt that, the industry is highly scattered. So our idea was to kind of bring everybody on the same table, same page. And because of the variety of products and the little bit of complexity of the product, our attempt is to make it more simple for everyone. So that's how we build. And at AIF and PMS Experts India, we run this show called Ask the Expert, wherein we invite industry experts like you, and we try and read your mind. So that's the whole idea. So the format of the show is very simple. We'll be asking you a few questions on behalf of our investors. And apart from that, we will try and learn something about how to create long-term wealth. So is that fine with both of you? Can we move ahead?
Yeah, absolutely.
Yeah, please go ahead, Vikas.
All right. So the first question is, to you, Mayur, is that, so if you could take us through your investment philosophy at IIFL, and a little bit of introduction, because I can see there are some new investors who have joined in today. They've taken the time out from their busy schedule. So a little bit of introduction. Maybe Ananya, you can start with if you wish to. And a little bit of introduction about your PMS vertical, how it started and where it is and where it is headed. And then maybe followed by that investment philosophy, if you could throw some more lights on that.
Sure, Vikas. So let me start with, and then probably then I'll request Mayur to pitch in when it comes to the philosophy and the framework on which our entire thesis of investment is based on. So let me start with IIFL. When we talk about today, we manage close to 55,000 odd crores of money, of the investors' money. And this is well spread across listed, unlisted, credit, real estate, and on offshore. And if I further bifurcate it within the listed space, we manage close to 25,000 odd crores. In the unlisted, some 22,000 crores. And that's being our foray, because very few people in today's domain is able to demonstrate the kind of leadership that we had shown in the unlisted space. And then we have 3,500 crores getting managed in the credit fund, which is the structured credits. Real estate is around the same size, and the offshore is close to 2,500 odd crores. So this is the breakup if I look at from a 55,000 odd crores that we talk about. In terms of our positioning, if I look at, I think we have been positioned as an alternate specialist. So I think that's the position that we had been enjoying for a long. And when I say alternate specialist, obviously I'm talking about both PMS and AIF contributing. And Anup has been spearheading this space when we talks about he being a part of the managing committee, investment committee, is one of the very key person looking after the entire thesis of investment. Obviously, very recently, what we also have done, in order to bring in the focus in the unlisted, we have got a gentleman, Anshuman Goenka, who has joined in as a CIO for the unlisted space. And overall, as I did say, that it's the committee which is there at the helm, which talks about the which ideas to onboard or not onboard, and Anup being a part of that committee has a very significant role to play, not only in the listed but also in the unlisted space. Uh, as an asset manager, if we talk about, as I said, we have an aspirations to build ourselves on the mutual fund side as well. We already have a focused equity fund which is doing exceedingly well, and the gentleman who is responsible for managing the fund is right there with us, Mayur Patel. I think he has been spearheading this focused equity. This is like one of the fantastic fund. Yes, I think I would rather take it on us. My team, the sales team, that we haven't spoken enough actually on the fund. Had we spoken enough, this fund should easily be around 8 to 10,000 crore fund across the. If I go back and look at last 24 to 25 odd quarters, fund had been a quartile one through and through, maybe missing 1 or 2 quarters in between, but had been a very consistent fund.
You're
But getting
referring
back
to which fund? You're referring to the
focused equity fund.
focused equity. Sure.
Yeah. Getting back to our alternate specialty, as I said, we have got very nice structure on the PMS side, which is the two strategies complementing very well to each other. I'm talking about, one is a multi-cap fund, which is an all-weather fund. It speaks about looking at growth strategies, and when Mayur will speak about the framework, he will bring in when I say growth, what do I mean by all of it? I think in that framework, when he explains you or the audience, I think you will be able to get a better sense. But just to give an overview, so multi-cap is a great strategy, which is an all-weather. And then we have a tactical allocation approach through a Phoenix fund. Phoenix is nothing but talks about more of a turnaround stories, strategies which has, because of internal or external factors, earnings have been pretty compressed one. But then as we go further, we see that the times ahead looks pretty promising. And hence, we have got a Phoenix, which is more of a tactical in nature. The beauty about the Phoenix is, on a PMS platform, it is called Phoenix. The same fund on an AIF platform is called Turnaround. Portfolio pretty much is the same, only the two differentiator is the two platforms. That's there. And as I said, in an unlisted space, we keep on coming with newer ideas. Currently, we are working with one of the series which is looking at investing into consumption, healthcare, and financial services as a proposition. So that's about us as a house in terms of our positioning and all. But the key to success, if I have to attribute, is one which is there is a very less ownership being at a people approach or people's approach, which we had been built our business. It is largely a process driven. And what do I mean by process is where I will request Mayu to now step in and talk about the entire framework. And largely, when I talk about a framework, what do I mean by a multi-cap and a Phoenix, and how the framework differentiate between the two strategies, is I'll request Mayur to come in. Mayur, over to you.
Yeah, so Mayur, so picking up from what Anunya said, so basically we want to understand that at a fund house level, what sort of investment philosophy that you follow. If it is defined, if it is not defined, then you can throw lights there as well. And how do we position your offerings? So these are the
Sure.
two questions.
Sure. So just Anunya gave a good background, but just want to add one point that we have crossed 50,000 crores recently, is at the AUM level. But when 3.5 years back, when we joined, Anup Maheshwari, me, and Mehul Jani, three of us moved from DSP BlackRock. We were all fund managers there working. Even Anunya was there for. I worked with Anunya at DSP also. So, but when we moved from that franchise to this one, this AMC was having a pretty large, around 10,000 crores, 9,000 crore kind of size in private equity side. But on the listed equity side, it was negligible, I would say. It was almost at the scratch level in terms of the business. Practically, you can say, was just emerging, right? And we joined here, and all the three, the focus was more. We are part of the listed equity. Obviously, Anup has some responsibilities at the investment committee level for the unlisted private equity side also. But our aspiration was to develop a very strong franchise which is built on trust. And trust comes when you have trust on our processes. So first 3 to 4 months time, three of us spent almost 75% of our time on to build the process and the philosophy, and what is the framework of selecting stock. So we should be very clear about what we want to do and what we don't want to do, right? And so the communication is also very clear, and the expectation from the client is also very clear, right? So significant amount of work went in the initial part of our tenure when we joined here, and that's where I'll share. And now we are consistently following our philosophy, our framework, how to select stocks, how to run the portfolios, how to manage risk. All these three things are very well inbuilt into our framework, and there is one slide which explains everything. So I don't believe in making a 20, 30 slide presentations. I believe more in terms of talking, taking more questions, connecting with the audience, and explaining everything in 1 or 2 slides, right? So that's what I'll do. So answering your first question is, Vikas, everything is well defined from day zero. From the time we entered the organization, in few months time, everything was, you know in terms of philosophy, framework, processes. Again, process keeps evolving, we keep improving our overall process, but the philosophy is defined, the framework is defined, and all our products are coming as a subset of this framework only, and I'll explain how, right? So this is the framework. We call it as a SCDV framework: secular, cyclical, defensive, and value trap quadrants. So basically breaking our universe, which is like BSE 200, but we have 250 stocks under our research coverage. So let's assume 250 stocks under coverage is all broken down into 4 quadrants based on return on equity and 15% profit growth. So 15% ROE threshold and 15% profit growth over last 10 years time, and our view over next 3 to 5 years time. So this entire 13 to 15 years time frame, right? So 10 years of actual performance and our expectation about next 3 to 5 years time. If the company is consistently delivering 15% profit growth, 15% and above, and 15% plus ROE, it is considered as a secular company. So uh, these are good quality compounding companies where you have 10-year, 15-year kind of stories like HDFC Bank and Bajaj Finance, and there are a lot of even mid caps we have like Awas Financials and things like that. So sectors, just for illustrative purpose, are like private sector retail focus banks, private sector retail focus NBFCs, insurance, retail, some of the auto ancillaries, consumer discretionary. These are high ROE company and high growth companies, right? So this is secular. Now I'll come to the allocation later. I'm just quickly defining the 4 quadrants, and then I'll come how we are constructing the portfolio, right? The next bucket. So the secular forms a core part of our portfolio. We would always like to have an overweight on secular. So as per our model, currently 23% of the benchmark is into secular quadrant. We are around 34-35%, so fairly overweight the secular quadrant. So this is a core part of your portfolio. Then it comes the tactical part of the portfolio. By tactical, I don't mean 3 months, 6 months view or that kind of tactical view. It's more like 1 year plus view, but not a 3 to 5 year buy and hold view, right? So the tactical part of the portfolio is determined between cyclical and defensives. So these 2 quadrants. So cyclical are companies like L&T, construction companies, private sector, corporate lending banks like ICICI, Access and all, infrastructure, cement, capital goods, industrial companies. These are the examples of cyclical companies where the companies go through 3 to 5 years of very strong growth. But over 10 years time, the ROEs are subpar. ROEs are less than 15%, right? But you have 3 to 5 years of cycles coming in. So that's cyclical. And defensives are like pharma, FMCG, IT, and media. These are examples of defensives, high ROE, but the growth is very modest over long periods of time, right? So based on our macro view, based on our view on the economic cycle, interest rates, on the market, all these top-down view, we allocate between cyclical and defensives, right? Because we do believe that, we have a lot of peers who focus only on quality and growth, which is secular, right? 100% of their portfolio is into high quality, high ROE, high growth companies, but all these are super expensive currently. So we do believe that there is enough alpha to be made in cyclicals and defensives also, if you time it well, right? And based on if your bottom up ideas are giving you enough, enough meat to capture in these two buckets, right? And it also helps to diversify. I'll come to the diversification later. So S, C, and D forms the, significant part of your portfolio. Core, secular. C and D you play based on your view on the macro. Like currently we are bullish on the cycle, we are more overweight on cyclicals and underweight on defensives currently, right? The last but not the least, value traps. These sectors or these companies struggle to generate decent ROEs, struggle to generate double digit ROEs, and deliver growth over long periods of time. So these are actually value traps. And again, we have other set of peers who always talk about value investing, but you have seen that there are enough stocks which have turned into value traps, but these are not value. So these are PSU companies, oil and gas upstream companies, telecom, utilities, and these kind of sectors. Now we also have some exposure to value traps, but we own a value trap only when we see things changing structurally, which can which can drive significant improvement in ROEs of that company because of regulatory changes, because of changes in competitive landscape, or any other company specific changes like change in management or the promoter holding, right? So example is Bharti, for example. It has been a value trap for last 10 years, struggling to generate double digit ROE, right? But now there are structural changes happening. From a 15 player sector, it has become a 3 player sector, effectively a 2 players sector, right? So there's a consolidation which has happened. Pricing power has come back. We are seeing ARPUs increasing. We are seeing regulatory environment has become more benign. All these factors are emerging, which can lead Bharti to become a double digit ROE company in 2 to 3 years' time, and it can come out of value trap and get into S, C, or D. Similarly, M&M is another value trap which we own in quite a few funds, where it is company specific. Company did a lot of mistakes in the past in terms of capital allocation. They have a beautiful tractor business, but they kept investing in a lot of stupid businesses and loss making entities overseas, and there are a lot of errors which have happened in the past. But with the new management in place, new CEO in place, the capital allocation policy has changed. They're getting rid of a lot of all these loss making entities, focusing on their strong tractor business, right? So doing all the right things at the company level. So in case of Bharti, it was a sector level or the industry level changes. In case of M&M, it is company level bottom up changes in the management, in the strategy, right? Which can lead it to become a double digit 15% plus ROE business on a sustainable basis. So these are some of the examples of value traps which we own, and we own it very selectively. Now, having defined the 4 quadrants, and I mentioned S as a core and C and D as your tactical allocation, this also helps in terms of diversification, right? People believe that having a 60 stock portfolio or a 70 stock portfolio gives you diversification and reduces your risk. you know there are enough books explaining that it doesn't reduce if you increase from 30 stock to 60 stock, right? The diversification comes from investing in different parts of the market. So secular gives you exposure to quality and growth. Cyclical gives you exposure to the companies which are cyclical in nature, right? Defensives gives you an exposure to companies which outperform normally in a volatile and a bearish market, right? So the 3 quadrants give you completely different exposures of the market. And we have seen over last, if somebody is in the equity market, for last 5 years or 7 years, he would only believe that quality performs because last 7 years only quality has performed. You buy a good quality company with some growth prospects, it has outperformed, right? But if you talk to somebody who is there in the market for last 30 years, We have seen cycles of cyclicals performing too, cycles of defensives performing too, right? So different parts of the market perform in different cycles. And this is where we believe we are different. We have exposures to all the three right quadrants, which gives you the right diversification. And the classic example is last 1.5 years time. You know, when you can have one high quality 15 stock portfolio having Nestle's and Britannia's and Pidilights and DMarts of the world, right? Which are all 70, 80, 90 P, and most of them offers 10 to 12% growth only. I don't know, you know, these have underperformed over last 1.5 years time. At the same time, you have commodities, industrials, cement, different parts of the cyclical component has outperformed, which was not the case, say, over last 7 years or 6 years. So that's what we believe, that our SCDV framework will help us to have a slightly more diversified exposure, despite having a concentrated 25 to 30 stock portfolio. So you can have diversification even in a concentrated portfolio by investing in different parts of the market, different factors of the market, right? So that's what we believe, that this also helps us to have a good risk management in place. And not just have just quality and buy ATP, Unilever and Nestle's of the world, at the same time having more alpha ideas in cyclical and defensives, because we have a very strong alpha creating team, very strong bottom up team. The focus is fully bottom up. This is used more as a SCDV and portfolio construct and for monitoring purpose, right? So another example I want to give, that we have almost zero exposure to consumer staples because we believe it's extremely expensive and it offers very modest growth. But we know, okay, we keep monitoring what is our weight in defensives. We have almost zero weight in one of the largest sector, which is consumer staples. We have a good overweight in IT services, for example. So because we are very bullish, I'm extremely bullish on IT services despite the last 1 year outperformance which these companies have given, because we are just at the beginning of a 3 to 4 year very strong growth cycle, right? So we then what matters is what is your overall weight in defensives. You can get a wrong impression that we don't have FMCG and hence we don't have defensives. No, our overall weight in defensives still 23-24%. We are underweight the overall bucket because of the staples, but still we have a decent exposure in this defensives bucket. Similarly, we are very bullish on cyclicals. We don't have much of commodities because again it's deep cyclical, right? But at the same time, we have corporate lending banks like ICICI Access and SBI. We have industrials like L&T, right? We have some cement names across the board. We have you know identified cyclical names, and we are 20 to 23% weight we are having in cyclical, which reflects our view. But all the names, everything is bottom up, right? So that's in short, the SCDV framework of selecting stocks, creating portfolio, and managing risk through diversifying into these quadrants. Because in different cycle of the market rewards different parts of the market components. It's never linear, right? So that's on SCDV. Another, before I wind up and hand it over to you, Vikas, for more questions. Another important thing to highlight about IIFL AMC is our strength is bottom up, right? If you look at our mutual fund portfolio or our multi-cap PMS portfolio, these are the two flagship funds which we have with very large. We have 2,500 crores of focus. MF, we never bothered to, like Anunya mentioned, to go on the road aggressively in market despite delivering. We are number two in the top three rank, or not only in the short term, but 3 year, 5 years, even 7 years, right? In these funds. But the core strength is bottom up. If you look at almost half of the portfolio is into really unique name like Apollo Tricort, Crompton Consumer, SRF, Awas Financials, and the list goes on, right? So that's what is our strength, to identify unique bottom-up alpha ideas, fit into our SCDV framework, and also comply with our risk management contours, and try to generate alpha which is more sustainable. So that's on the SCDV framework. In terms of, as I mentioned, the mutual fund and the PMS are the flagship funds, where we are currently overweight cyclicals, underweight defensives, and having overweight on secular. We are very bullish in defenses, very bullish on IT services. To balance it, we are very positive on the financials, banking and financials, because this sector is underperformed, and long term we like that sector. So, and industrials, which is your capital goods. So industrials, capital goods, and financials on one side, and IT services, another large sector on the other side, are the two main balancing act. Then you, in between, you have quite a few bottom up names coming across: chemicals, consumer durables, building materials, and things like that. So let me take a pause so that we can get into more Q&A and extend this discussion.
All right. So that's a pretty detailed one. Thank you for sharing it. So basically, you follow a framework which is SCDV. Is that correct?
Absolutely.
Okay. So, and then you have a flexibility. What I learned is that depending upon the way market behaves, you keep moving from one to another pocket.
So we don't churn significantly, but there are certain times which, for example, when the COVID first wave hit us and everything was uncertain, right? No, it was like a doomsday scenario. So that at that time we took pharma weight to almost 18% in our flagship funds. The benchmark weight of pharma was 6%. Not a single fund on the PMS or a mutual fund side you would have found in March, April, when the first wave came of COVID, having that kind of allocation in pharma. And it was all bottom up, but the allocation changed based on the top down view. We continue to invest in the same stocks which we liked at that point of time, but the D allocation we increased by increasing pharma. At the same time, in September, October, when the reopening thing started, we got much more clarity about the cycle picking up, government thrust, everything. At that time, we increased our cyclical component more, right? This is, I'm talking about March, April 2020 and September, October 2020. Right? But our mutual fund is there in the public domain. Our portfolio turnover is pretty decent. We don't churn frequently. So this SCDV gives us the flexibility, but that's taken when it actually warrants a change in terms of allocation between cyclical and defensives.
Understood. Okay. So what is the difference? Any one of you can answer these questions. What is the difference between multi-cap and the advantage? There are questions which keeps coming on and off from our investors. So if you can throw some more lights on the difference between these two.
You're talking about multi-cap and a multi-cap advantage fund?
Yeah, in the PMS space.
Yeah, so I think if you would have heard me while mentioning about the PMS offering, I purposely said multi-cap and the Phoenix, but didn't mention about multi-cap advantage. The reason for doing so was we aren't taking any money in the multi-cap advantage fund because of certain clarity that we are seeking from regulators. And multi-cap advantage, what it used to do, it used to help us build some kind of a hedge by taking the options route. And basically, you can say you could have bought some insurance by paying some premium for that. So in the downside market, because of those insurance that you had bought, it would have just given you some kind of a hedge on the drawdown side. But we aren't taking money into that fund anymore. So, which is the reason today, both me and Mayur, when we mentioned about the PMS offering, we only spoke about multi-cap and the Phoenix.
Yeah, that's okay. So basically, what we wanted to know is that there were few requests from some of our investors. So they wanted to know the differentiation. Yeah.
Only one point is it's same like multi-cap PMS, but we normally buy Nifty put options 3 year out, so it gives you 3-year coverage by having that put options. Obviously, it has for 3 year it would have a cost of anywhere between 5 to 7% you have to spend to get that insurance, right? But it's like saying that you get the Nifty downside. the portfolio will always have 25 to 35% of small and mid caps, which in say if market is down 10%, normally the small and mid caps fall more. So it is not a pure hedge, which we always clarify, but it definitely gives you some protection in a very declining market, which we have seen in the first wave and some of these volatile periods. So it's a it definitely gives you protection, but it's not 100% pure hedge.
Okay, so we'll come to the topic also. So now everybody wants to know more about your new product which has been launched, IIFL Phoenix PMS. So if you could take us through how do you select stocks, what all, a little bit about the product itself. Over to you.
Yeah. So as I mentioned, the SCDV framework for our mainstream flagship funds like mutual fund and the PMS, right, where we have a large portion of the portfolio, right, into S and D, secular and defensives. As I mentioned, we have a 25 closer to 25% weight in defensives, around 35% weight in secular, right? So you can say closer to 70% weight is into S and D, and always that these are our evergreen. We try to create it as an evergreen kind of portfolio. Buy with a 3 to 5 year view and just forget it. Over volatility, the 70% of the portfolio is into secular and defensives, which are obviously which comes with less risk. Uh, at the same time, when we look at the Phoenix portfolio or the turnaround portfolio, which is a turnaround, so we are clearly saying it's a higher risk strategy. But in the current environment, you are getting a lot of interesting ideas in that strategy. So which would be focused more on C and V, much more riskier component, cyclicals and value traps. While we are before buying a value trap in our mutual fund or a multi-cap PMS, we will think 100 times. In buying value trap in Phoenix, we will think 100 times, but you get a lot of interesting turnaround names there in value traps, which fits into that mandate. So these, so C and V would form a large part of the portfolio. Again, we look at we have a proprietary model of 6-7 parameters, where we believe that at least out of 7 parameters, 4 to 5 parameters should be met for that stock to come into our portfolio. The first parameter would be, for example, upgrade in a quadrant.
So do you have a presentation also, if you could
Yeah,
display?
1 second, let me just.
So this is the open-ended, right? Open-ended PMS. Anybody
Yes.
can participate. Okay.
So this is what I was talking about. Good quality companies having short-term business disruption. Last few years have been bad. That's why the stock is punished. It is coming as cyclical and value traps because of last 3 to 5 years performance, but last 10-year, 15-year history is very good. And we do see some turnaround event, which can lead to improving fundamentals and value creation and re-rating. So the turnaround event uh, could be internal factors, which I gave the example of M&M, for example, right? When there is a change in management, there is a business restructuring, selling out of loss-making units, capital allocation strategy has changed, and new product introduction kind of. So these are internal factors. There could be external factors, which I mentioned in terms of Bharti, like industry dynamics are changing from 15 player to now 3 player. Pricing power is coming back. Regulator and the government policies are becoming more benign for the telecom sector. M&A and JVs. So these are external factors. So because of either of these two set of factors, there could be a turnaround event which can bring back the company into a good growth and good ROE trajectory over next couple of years time, right? And that would lead to financials will start looking good, ROEs will start looking good, earnings growth will start looking good, balance sheet will improve, and all these things will drive the re-rating in the valuation. And so, as I mentioned, there has to be an upgrade in our SCDV framework. A value trap should either become a cyclical or a defensive or a secular. A cyclical company should become a secular company, right? So, based on our model, our research, 2 to 3 years out, we should see this upgrade happening in our SCDV framework. So, these are the criteria: upgrade in the SCDV framework, lower profitability versus historical trends. Say a company is having much more lower margins last 3 years, but historical margins have been pretty good, right? Proven track record. Long-term track record is very good. 10-year, 15-year track record is very good in terms of ROEs. Trading at a discount to historical valuations, right? So trading at a discount, for example, the company in good times used to trade at a pretty decent valuations at 25, 30p. Now it's trading at 15p. Right. So there's a good part of the market is now trading at a premium to its historical valuations. When we do see some of the good quality companies going through a rough patch available at a discount to historical valuations, it's an opportunity. There's a change in management or change in ownership. Sometimes the business has gone through a lot of turbulence because of the management policies, because the owner is not doing all the right things. And if there is a change in this factor, it definitely can drive improvement. Forensics and strong governance. Business can go through turbulence, but forensics should not show there is a intent is a problem. There should not be a fraudulent intent. Governance should not be a problem. Stocks where price correction has occurred means the expectations are low, and that's where non-linear returns are made, right? A beautiful growth company, well known, well discovered, and everyone has bought it up to their neck. The expectations are huge. So this is reverse of that. And then we have some case studies like SRF, how ROEs were 8.2%. There were there were massive capex happening. Things went down, and then the management focus improved on the chemical business, and the entire capex which they did started giving results. And how the stock price delivered 47% CAGR from FY14 to FY21. It was a D in our SCDV framework. It became an S in our SCDV framework, right? Uh, Similarly, another example is IPCA. There was import alert in IPCA. The US business value went down significantly. The management changed gears, focused more on the domestic pharma business and the rest of the world pharma business. And the entire change in strategy helped them to deliver 60% CAGR profit growth from FY16 to 21. There was an upgrade from D to S, and this is how the stock delivered 27% CAGR from FY16 to FY21, right? So these are some of the examples of the turnaround stories, right? And so yeah, that's pretty much 7 parameters. Focus on more turning around stories, CNV heavy portfolio. So it's completely different from our existing flagship funds in terms of the approach. While some of the cyclical names, which we have it in our flagship portfolios, can be there, can be present in our Phoenix also, because it is cyclical. It is forming that cyclical representation in our flagship portfolio. It can be here, but it is a unique proportion as compared to our IIFL multi-cap PMS and our IIFL focus mutual fund.
Can you just show that metrics between BSE 200 and the portfolio metrics? I think that's very compelling slide. Do you have it with you, or should I share that?
You share it. I don't have it.
I'll take it. Sure.
Yeah, one point here, in the meantime, is opening up the slide, Mayur. So you mentioned that the ROE should be 15% and above. Should have a proven track record. Now, if that is the case, then it comes under your other, bucket, which is your more of stable
Defensives.
company. Yeah.
Yeah.
So
No, this I'm talking.
Be the turnaround. Yeah.
No, so this is more like last 10, 15 years. Before the turbulent period, the company had a track record of 15% plus. And last 3-4 years have been bad, for example, and the ROEs went down to 10, 5 or whatever. But there's enough history available
Okay.
right? For that company, this is a good promoter, good ownership, good franchise. In the past, it has done a good job. That's the thing. So it's not the
Understood.
recent. Yeah,
Understood.
yeah, 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 Nunya.
Yeah.
Yeah, just a minute. Sorry. Is it your screen or my screen, Mayur?
It is your screen, Anunya.
This is my screen only. Yeah,
Yeah,
I can see
yeah.
it. Yeah, sure. Just open that. Anyway, you please continue, Vikas. I'll just pull that thing out. Just give me a second. In the meantime, you continue with your other questions. I'll pull this
Yeah.
out.
Yeah. 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 So the other thing is, Mayur, so last question from my end is,
Yeah.
so what is your house views as far as market is concerned at this point of time?
Yeah. So let me just share my screen. There is
Sure.
again one simple slide. Uh, Anunya, can you stop sharing, Anunya?
Just a minute, please. I'll stop it. Yeah, I've done that, Mayur.
Okay, okay. Just give me. Yeah. So is this screen visible? One second. Yeah. Can you see?
Yeah.
Can
Yes. Yes.
one second. Uh, yeah. So this one. So Vikas, this is a very simple slide. Last 20 years data we
Yeah.
have of BSC Sensex price to book. Okay. Now I have seen that, talking about specific market direction in short term, next 3 months, whether Nifty will go to 20,000 or go to 15,000. 99.99% of the investment professionals have got it terribly wrong over last 2 years at least, if not over long periods of time, right? So the best way to do it is just to analyze the risk reward before talking about the outlook. So this gives you a very interesting perspective. If you see last 20 years, the BSE Sensex has traded 85% of the time in the band of 2 times price to book to 4 times price to book. Okay. So this is the band. 85% of the time market is traded between 2 times price to book to 4 times price to book. So below 2 times, whenever it goes, rarely it goes, you have to buy lock, stock, and barrels. So it went down in the first wave. Obviously, it's easier said than done, but that's where you have to go really massive allocation to equities, and above 4 times price to book, the risk reward becomes very poor. So we have seen whenever you are investing in the market, when the market is trading at 4 times and above price to book, your 5-year returns would be around 4-5%. This is based on the last 20 years statistical analysis. Okay. So the best thing is you keep investing based on the macro and the outlook and whatever view you have. If it is between 2 to 4 times price to book, that's the band to invest. So where are we currently? We are at 3.6 currently. So not very cheap. We are very coming closer to that 4 times price to book band, but not at a very alarming level that you should get out of the equity because the valuations are really bad. That's not the case. Okay. So let me set that note. One second. Yeah. No, having said, so this gives you that yes, the valuations are still not very extreme in said, so that it warrants that complete outflow of equity from the equity market. Now, what to do? If you see the first leg of rally from the bottom, let me first talk about the negatives, and then we'll talk about the positives, and then the overall view is the first leg of rally from the bottom when if from the first wave bottom purely was driven by liquidity, massive liquidity infusion by the central banks, massive fiscal stimulus in US, giving free money in the hands of the consumers, right? Similarly, in India, massive liquidity infusion in the system. Fiscal stimulus was indirect, I would say. We didn't distributed money in the hands of consumers directly, but it was all liquidity driven. And then the reopening theme and other things followed. Now that liquidity aspect is reversing, right? The Fed has clearly chalked out a path to end the quantitative easing. Why I'm talking about Fed and all? Because we all know that the domestic factors are important, but the global factors are very, very much important, because that's what drive FI flows and emerging market flows. And that's what, to a great extent, for example, our Nifty was down 20% even before announcing a single or any material COVID cases in India. But market was down already 20%, right? So, so the global factors are very important. So that entire tapering, that liquidity infusion is reversing. They are talking about 3 rate hikes next year and more. So that entire central bank related, you know, that positive factor is reversing, which can drive outflows, which can drive, put pressure on the emerging market currencies. We are already seeing that, right? And bond yields, that are also happening currently. So all these things are happening. Just give me one. Yeah, sorry. There was 1 second. How to?
Yeah, you can go ahead.
No, I'm just figuring out how to put on the video.
Video, just click on the video option, video button.
Yeah, 1 second. Anyways, there's some problem at my
You can
end.
continue with this present thing, and then we can turn on the video.
Yeah, it's happened. Yeah, sorry. So, so that's the negative from the flow point of view. And it will happen. Dire dire, slowly it will happen. When the Fed announced this entire strategy in December, the bond yields didn't react immediately. It was at 1.45, 1.5, around that level. But by the time we came January, now it's like 1.7 and higher than that, 10-year yields. Even the short-term yields have bounced, right? So that will happen. Inflation is sticky, whether we like it or not, across the board. So these are the negative factors which can create volatility in the short term. Next 3 months can market, these factors can pull it down by 5, 7, 10%. Possible. It's not ruled out. Okay. Uh, because of these factors. But next 2 years is looking extremely interesting when I look at the domestic factors, right? We are just beginning to enter a very strong economic growth cycle. The capex cycle is just, it is going to be the any companies we are talking about in chemicals, in pharma, in API, in cement, in commodities across the board. People are hungry to expand capacity. The demand has been very resilient, right? The capex cycle was completely dead for last 5 years. Next 3 years is going to be very robust. It will start with the government driven capex cycle, followed by private sector capex cycle. That's my view. And that will also reflect in the credit growth of banks. As we speak, the credit growth is around single digit. The retail credit growth is doing well. The corporate lending is yet to pick up. That will also happen in next 6 months' time. You will see a double-digit credit growth, in my view, in 6 months' time from a single-digit credit growth. Capex cycle picking up, credit growth picking up. Consumer discretionary demand is going to be extremely robust over next 2 to 3 years' time, right? You can look at any of the, except for the automobiles, which has been the lagged, sector in the consumer discretionary. But the consumer discretionary other buckets like consumer durables, you look at jewelry, across the board we are seeing very strong demand, and auto also will pick up going forward. So we are looking at anyway the economic cycle was very bad before COVID itself. So there was a 4 or 5 year of very strong low base which has been created, and then after COVID the base was further damaged. So from here on, next 3 years is going to be a strong growth cycle in these pockets, right? To play that, you know, equity makes a lot of sense. Obviously, as I mentioned, there are short-term negative factors, but to play this cycle, you can make decent amount of returns over 2 to 3 years time. So don't try to time the market, take a 3 months view. I would rather say spread it out over 3 4 installments over next 3 to 4 months time, but don't miss the 2 to 3 year story. That's the in short directional view, which we believe makes more sense, talking about the direction and the risk. So you can always argue that the risk factors which I mentioned in your view could be much more overwhelming than the positive factors which I mentioned. So you can have a slightly more conservative view on the market than me, right? With the same theory, same factors. I think that's make more sense because nobody can predict market. Okay. So I think this is a direction. These are the risk factors and these are the positive factors. I would like to play a 2 to 3 year, good equity story despite the run up currently which has happened, and invest through this volatility with a 2 to 3 year view because of the cyclical upturn which we are seeing.
All right, so you can turn off the video before we conclude last couple
In
of
fact,
questions. Yeah.
because this is the sheet I wanted to show, which is
Oh.
about talking about the portfolio quants.
Yeah.
While this is for the turnaround, but pretty similar to what Phoenix is. Mayur, would you want to spend a minute on this?
Yeah.
Yeah, 1 second, Mayur. So there's anybody who has any question, please type in your question in Q&A box and post this conversation. We'll start taking one by one. Over to you, Mayur.
Yeah, so this is what I was saying, that the cyclical, if you see, the cyclical is 27 and 29% is value traps. So which is pretty large. So around, you can say closer to 60% of the portfolio is into C and V as compared to the benchmark, which is around 40% of the portfolio is into C and V in the benchmark, right? So this is what I was highlighting, that this portfolio is more slightly more risk, but it can give you non-linear upside in the medium term because of this positioning which we have here, right?
And adding to that, because if you go to the last metric, the portfolio metrics, and look at this price to book and an ROE or an EPS growth as a proposition, what you will notice is that EPS growth for the portfolio is almost close to 54%, vis-a-vis the benchmark being in the early 30s, and price to book is pretty much the same. So in terms of the point that Mayur was emphasizing on the non-linearity part, I think that's also getting reflected pretty well from the metrics perspective, that you have a better earning as a proposition, yet not very much priced in. So from all the perspective, and if you look at our view is that for one to look at a Phoenix or a turnaround, depending upon which platform that you would want to onboard the client, has got a lot of relevance in today's time on a tactical note.
So the CPS growth is basis the current scenario or the future expectation?
Future expectation.
It is written for FY 21-23.
So which is 54 vis-a-vis the benchmark, which is at 31%.
Yes.
Yeah.
And okay, what would be the ROC, if I may know?
ROE we have plotted. It's closer to 17% is a blended ROE of the portfolio, as compared to 15.5 or closer to 16% is the benchmark's ROE.
Great, yeah. Okay, so we'll take Q&A.
Sure.
So
I saw there is one question already there.
One question has already come in. Correct. So the first question is, you can turn off this presentation. So the first question is, how much overlap do you expect in the portfolio of IIFL Multicap and IIFL Phoenix PMS?
Yeah, so I don't have that number ready, but it would be somewhere in the range of say 25 to 35% could be the overlap. As I mentioned, cyclicals, the cyclicals which I would like to buy in Phoenix, I may also like to buy in the flagship funds, because they're also that part of the portfolio I want to play cycle. Here also that part of the portfolio I'm playing the same cycle. The value traps could be more here. There could be difference in value traps and all, but cyclicals is where you'll find more overlap, in short. So which is around 27% in Phoenix. Say ICICI Bank is a cyclical company in our view currently, poised for a very strong cycle. It is the largest weight in our flagship funds. But we believe that the same value creation because of the turnaround can happen in Phoenix also. So we do also have in Phoenix the same cyclical. LNT, for example, it's a turnaround story. It has been a dud stock for last 5 years, except for last 1 year. Right. We have a reasonable large weight in our flagship funds, right? But we also have it in say Phoenix LNT because it's a play on the turnaround cycle. It can give you non-linear returns if the cycle picks up, right? But then there's a long list of really unique value traps and other names where there is a turnaround. So it's not that 60, 70, 80% overlap you will not find, but some overlap would be there.
Okay, Anunya, so out of this 50,000 crores that you talked about, what would be the breakup between listed and non-listed space?
Listed would be close to, I think, almost 50-50%, you can say. 29,000 crores is in a listed and rest all is in a non-listed space.
Okay. So both comes under the AMC arm, right?
Absolutely.
Okay.
Yes. So just to give you a perspective, almost more than half of our listed is comprising of 4 large foreign mandates. These are, a couple of universities from US, one of the marquee universities from US, one Canadian pension fund, and one sovereign fund from Middle East region, right? So that's again, that is nothing to do with our domestic clients, domestic money. And remaining half of the portfolio is from this PMS, mutual fund, and AIF platform.
All right. So a lot of investors are interested to know more about unlisted also, but we are running short of time here. So we'll conclude that and we'll have a separate session for unlisted space.
Sure, definitely.
And
Sure.
we'll coordinate with Ananya for that. So
Sure.
thank you, gentlemen, for taking the time out from your busy schedule, joining in today, sharing your investment philosophy, talking about the outlook of equity markets. So thank you so much. I also take this opportunity to thank all the viewers who joined in today and had had a couple of queries which they kind of clarified. So thank you so much. It was
Thank
pleasure.
you. Thank you, everyone. Stay safe
Yeah.
and have a
Thank
good time.
you. Thanks. Yeah. Bye-bye. Bye.